Have you played around with calculators and you're trying to figure out whether it is better to buy Bay Area real estate or invest that money into the stock market? Are you curious why some of the biggest rent versus owning gaps and spreads are in some of the most expensive places in across the Bay? Why are the rich doing this and what do they know that everyone else doesn't know? Well, today we're going to be able to answer all of that because you've played around with all sorts of different calculators, but there's a lot of things missing with those calculators that are not having the right expectations. But you got to ask yourself, why are people buying $2 million, $3 million, $4 million, $5 million homes when they could just easily invest that money into the stock market? We all hear that the stock market has increased 12% a year versus the Bay Area real estate, especially when it comes to single families, is only at a measly 8% a year. Well, today we're going to be answering all of that because we're going to be asking Grok, and you can use this for any AI tool that will answer this question, and I'm going to be showing you what the results are and why people are doing what they're doing. This is going to surprise you because it's not just simply 8% versus 12%. Sid, if you're watching this, this is a little bit of a credit to you. But now we don't even have to go with the fancy spreadsheet. Let's get right into it. My name is Spencer Su. In the last year itself, we've helped over 60 families successfully with their moves. And so every single week, I get to experience this firsthand from really smart people that are either buying or selling their Bay Area real estate with me. And if you want to go over a game plan, my contact details are below. Okay, so what I love about this is that you can be able to ask your own scenario questions with a platform like this to help you understand your options a lot faster than just using those generic calculators that, quite frankly, don't have a lot of detailed information in. But now, with AI and all these different tools, whether using Grok or ChatGPT, it's going to be really helpful. So here's how I would personally calculate this, but you can feel free to play around and do it yourself. My first question is, how much has the S&P actually increased versus Bay Area housing? Let's take a look. And let's say, for example, Bay Area housing for single family. And you can play around with these however you would want. So my first objective is just to see, is from a pure growth perspective, which is better? I know the answer to this, and the answer is going to be the stock market is. So, but let's take a look for you so you can see for yourself. So you can see this, the S&P has increased to early 2025 about 12.55% a year. Now, what about when it comes to the Bay Area real estate market? You can see the Bay Area real estate market, they're writing it is at 5.1%. Now, this is not, I wouldn't say this is exactly accurate because it depends on the city and the area that you are looking at. But even if we take into this account, let's just use this information. So you may look at it like, wait a second, wow, the S&P has grown so much more than Bay Area housing. Why would anyone want to buy Bay Area housing? Why do the people that have the biggest rent spreads in very valuable areas, $3, $4, $5 million homes, why do they still do it? They do it because of a lot of other factors. They do it because of the actual how much money they're putting in. They're doing it because of the capital gains exclusion when it comes to taxes. Let's run all these scenarios together. My next question I would ask myself is, if I make X amount of money a year, how much of a home can you buy? So let's see what Grok comes out with. If you make $500,000 a year in the Bay Area as a couple, how much of a home can you potentially buy up to? So let's take a look. And typically people could put 20% down. I'm going to look at these numbers. I do want to verify some of these because some of these are incorrect. But let me show you something momentarily. So let's take a look at some of these. And we're going to have to correct some of these because these are incorrect. Typically property tax, I'm just going to go down the list. And that's the beauty of doing such a thing. Let's just go down the list. So property tax is not 1.1%. Property tax is 1.25%. Insurance, that's about right. There is no HOA fees, especially for most single family. We're going to look at single family for now. They look at mortgage rates at 6.72. That's incorrect. Right now, mortgage rates, especially with the big banks, if you're buying at this price range, you can easily get in the mid fives. So we're going to fix that because this is also incorrect. And so there is a few things you have to actually adjust with realistic expectations, good or bad. Mortgage is 5.5%. All right, let's take a look further. You're going to be put 20% down. That's fine. We're going to remove HOA. There is not going to be an HOA. So they're saying you could buy up to be $1.9 to $2.1 million. Let's get this corrected. So property tax would be higher, HOA would be lower. Technically, this is just, they're using this affordability rule of 30%. From a bank's perspective, they will allow you to borrow up to 45% gross debt to income. So we're going well below the means. But if you make a combined $500,000, the reality is you can buy around a $2.2 million place. This is what it is. You can argue with it all you want, but this is like generally what people can buy up to if they choose to do that. So the next question is this. I want to ask ChatGPT, what is better? So we just saw previously, if housing appreciates, and we use their number, which is a conservative number, and I've showed you many times, the actual average is about 8% a year, and I'm happy to show you the other stats. But if housing appreciates 5.1%, S&P increases 12.55%, you got to include capital gains exclusion. As a married couple, and 6% transaction costs when selling for 5 years, which is a better investment decision. So let's break it down and see what did Grok say about these numbers. So we included everything. We included your transaction cost, and let's break it down in terms of all these individual numbers. So when it comes to housing, let's say you started off with a $2.2 million because you're buying at the higher end of that range where you can buy up to. So even assuming 5.1% a year, this will increase to about $2.82 million. So if you look at the difference, 2.82 million minus 2.2 is 620, and you can see the math breakdown. This is the biggest reason why it's so valuable for people to use this as a stepping stone. Number one, you're using leverage. Number two, you have this capital gains exclusion. Take a look at how much you're getting taxed, even with your high income earner. This is a big deal, right? This is a huge part of the equation. And so when you look at the proceeds and you look at the actual cost, you can see that your return is very, very high, especially with leverage. Now, when you look at the S&P is going to be a lot more straightforward. The catch is there's not going to be any sort of real tax benefits of it. So especially if you live in California, you're going to have your long-term capital gains in California, and that's going to significantly impact this information. Now, if you look at the actual numbers, take a look at this. See? Cash on cash, housing's 9.977% return on the $440,000 cash invested edges out of the S&P's 8.97% as a total. Now, by the way, this assumed that the Bay Area housing was only at 5.1%. But let me give you a breakdown of this. This is actually not correct. Let's break it down for you so you can see for yourself. What is the CAGR of housing if the median price was, let's use as actual numbers. These are Santa Clara County starting from January 2012. Pick a random time. Was $480K in January 2012 versus now 1.982 versus February 2025 1.982 million. So let's have them do the math for us. Make it easy for us. You don't have to be an Excel spreadsheet for you to be able to figure this out, or for them to help you figure this out. So let's see what the CAGR would be given these different endpoints. Look at it. The CAGR, as you can see, for Bay Area, and this is Santa Clara County. Now Bay Area may be a little bit less, but the CAGR is actually 11.68%. So if you actually did the math now, let's go back. Area housing instead. Make sure this calculates the taxes. This is, I think they calculate it right, but let's just add it. Which is the better investment? Right, so the cool part, you can actually ask these questions. You just got to be able to review it, make sure the information is actually correct. You're welcome to ask me for the data. Like, this is all public information, right? Like, there's nothing hidden about it. If you look at the search, it literally says residential, single family, Santa Clara County from those time periods. So let it run, do its thing, right? And then just take a look at this. Absolutely Housing crushed it. So as much as the S&P has grown, the overall returns is actually significantly better because of the fact that you're maximizing leverage. You also have the capital gains exclusion, but it's such a big gap. Look at this. With your $500K income, housing's higher profit, $1.2 million versus $236,000, could outweigh the S&P's edge if you're bullish on the Bay Area growth and you plan to live here. Now, of course, the S&P is more liquid. Now, the liquidity may impact you in terms of when you may sell and when you may buy. But you can see, like, this is the clear reason why people are buying Bay Area real estate and why it makes sense financially to do so, even though your returns on the S&P, if you're buying in all cash, is that way. But that's also part of the reason why this leverage is so important and so powerful, especially when you plan to live here anyways, right? And you're welcome to play around with this model. See how much, because you'll be paying rent. You'll be paying rent in the meantime. Does that actually calculate that? Let's actually ask that question. Does this math include how much you would be paying rent in a similar property? Well, let's take a look. The previous analysis didn't even include rent. Right? I mean, if you did include rent, I mean, look at these numbers. It's going to be really bad. Like, it's going to be so clear. Right? Because you're going to still be paying something in rent. Housing is far better. Now, this is kind of high. I don't think this is the right rents. So this is why I'm telling you, you got to play around with it too. You also got to make sure this is correct. So let's see. The regular ratio right now is, if you're renting the same house as this, assume rents is usually, rental is about 0.25% a year. So just to give you an idea, 0.25% a month divided of that monthly rent is relative to the purchase price. So if you are if you were going to be able to afford, if you're going to rent a place like this, you'd probably be paying, let's say let's say it's $6,000. Let's make it easier. Let's make it even seem better. Assume rent is $6,000. Let's do it. So now you assume you'd be paying for rent, because that would be what you'll be. You'd be very happy to pay $6,000 a month in rent for a $2.2 million place. That doesn't seem unrealistic. So you'll take advantage of the S&P growth, but you'll still be paying the monthly rent itself, right? So you can do that factor, and you can just see it. Look at the difference. Look at how much it is. Profit, housing, $1.02 million net profit far exceeds the S&P's $294,000, even with lower rents. Because remember, you're going to be paying something while you're not doing anything, right? So even though the S&P as a sum has done better by a long shot, but when you actually look at the real numbers, that's not how it works. And you see these numbers that I just pulled too, right? So this should give you a pretty good idea as to what to expect in terms of what is truly the better investment, right? And I wanted to break this down for you so that you can visually see for yourself. But I also wanted to leverage, like, these tools are available. These different tools, AI tools, ChatGPT, are going to be helping us tremendously in all sorts of different ways. Why not help you try to figure out your own goals a lot faster? Now, I can help you tweak these information, right? I'd rather give conservative numbers for all of these. But if you're going to match the S&P 500 with the Bay Area real estate market, well, I'm going to show you that too. So if this encourages you to want to buy, sell, or invest sooner, then I'd love to go over that game plan, right? The S&P, obviously, you have liquidity. Depending on where you're at with your life, there's different things for you. Now, the other catch is this. The longer you hold on to the property, eventually there will be an intersection. So the next logical question I'll ask is, what is the intersection when the S&P is better? Right? Because that's the question that I'll also have in mind too. There is an intersection. That 5-year time frame already makes sense, as you can see, to buy real estate. But then the question is, how long would you have to wait, right, for it to eventually break even? And there will be a point where it breaks even. So let's let them do all the math, because there is no way any sort of calculator that you have will be anywhere close to this, right? There's no way you have any calculator for this at all. So let's see the length of time. Okay, that doesn't help that much. So if it drops below $5,200 a month, well, that's not going to help. Let's do another one. What is the length of time of holding Let's try this instead. This will be an intersection. But remember, the difference now is that 11.68 is a big deal, right? As you can see of what it has been. And you can play around with it. Maybe it's 8%, but you got to also be able to play around with the other side of it too, of like, is the stock market going to continue to increase at that amount either? I'm literally pointing at the same exact times that is out here. So let's see what the gap is and when it may be. I mean, look at this. This even shows you there is no scenario where it can even make sense because of this spread and because of rent's drag. This gives you the very clear reasons why. And I encourage you to do it yourself. And then if this works, reach out to me. I love to help. We can get you on the game plan. We can help you figure out what you can buy. We can get you that 5.5% if you're buying this kind of property, and we can get you underway, successful with your moves. I hope this was helpful. I gave you a lot of details about this, but I highly encourage it. This is all free. That's the beauty of all this. It's all free information. But this should hopefully allow you to figure out your options a lot faster than you would have otherwise thought of. Let's go over our game plan. My contact details are below. Talk soon. Bye now.